Okay, if you've ever let a credit card balance roll over from one month to the next, we really need to talk. Today, we're diving into this explainer to uncover the actual, true cost of carrying debt in India, looking specifically at the 2026 interest rate landscape. We are going to take those tiny, harmless-looking monthly rates and translate them into their real, annualized realities.
To kick things off, I want to ask you a question that gets right to the heart of this whole thing. When you check your statement and see a standard monthly interest rate of, say, 3.5%, it's just a single digit, right? It feels super small and totally manageable. But here's the question. Does your bank's 3.5% rate actually mean 3.5% when it comes to the hard-earned cash leaving your pocket?
Well, the shocking reality is absolutely not. When fully accounted for, that innocent-sounding 3.5% can actually represent an effective annual rate of 51.6%. Just let that sink in for a second. Think about the interest rate on your home loan or your car loan. Now stack that up against 51.6%. It's wild. This massive disconnect between how credit card interest is marketed versus how it's actually charged is exactly what traps so many consumers.
All right, let's jump into our first section, the industry standard rate, the baseline illusion. So when you look at the major players out there, this baseline illusion becomes pretty obvious. Whether you bank with SBI, Axis, Kotak, ICICI, or HDFC, you're essentially looking at the exact same standard rate across the board. You might spend hours comparing reward points and airport lounge access, but at the end of the day, the industry has universally settled right around that 3.49 to 3.5% mark. It really is an illusion of choice.
But, as always, the devil is totally in the details. You've got to read the fine print behind these uniform numbers. Take SBI Card, for instance. Their 3.5% rate kicks in immediately from the transaction date if you carry any balance forward. Basically, the clock starts the literal second you swipe. Now, ICICI is kind of interesting. They operate a bit differently, offering these unadvertised rate reviews for excellent repayment history, but you have to explicitly ask for it. And then HDFC comes in just a tiny hair under the average at 3.49%.
Moving on to Section 2, the premium card myth. Does paying more save you money?
You might naturally assume that paying a massive annual fee and proving you have a high income would, score you a better borrowing rate. But if we compare a basic, entry-level Axis card to the ultra-premium Axis Magnus card, we see a pretty fascinating story. The Magnus has a hefty 12,500 rupee annual fee and all these exclusive perks. But look at the interest. They both charge the exact same 3.50% monthly rate. Paying more for a premium card doesn't actually buy you a cheaper rate when you need to borrow.
So the big takeaway here is that banks treat your revolving debt exactly the same no matter your premium status. Seriously, it doesn't matter if your card is made of heavy metal or if it gets you into first-class lounges around the world. The moment you decide to carry a balance into the next month, you are placed in the exact same risk pool and charged the exact same premium interest rate as the entry-level customer.
Okay, Section 3, exceptions and charge cards, the outliers in the market.
Now, there actually is one genuine exception in the market right now. While everyone else is comfortably parked at 3.50%, IDFC First Bank visibly undercuts the industry average. They're offering rates as low as 2.50% per month on select premium variants. It's a pretty significant drop compared to the rest of the pack, and honestly, it's the only real deviation we've found in this space.
And then we have a totally different financial tool entirely, the charge card. You've probably seen this popularized by American Express. With something like the Amex Platinum Charge, the whole concept of a monthly interest rate just goes right out the window. Why? Because the model strictly requires you to pay your balance in full every single month. Revolving a balance isn't even an option, making the interest rate completely moot. You literally cannot fall into the revolving debt trap with this product because it essentially forces financial discipline on you.
Let's head into our fourth and final section, the harsh annual reality, doing the math on debt. All right, step by step, let's break down how this math actually works. This is crucial. You start with that standard 3.5% monthly rate, right? Well, because interest compounds, annualizing that 3.5% doesn't just mean multiplying it by 12. No, it balloons to roughly 41.88% annually. But wait, we're in India, where financial services attract an 18% goods and services tax. Once you add that GST on top of the interest, boom, you hit that staggering 51.6% effective annual reality we talked about at the start.
And honestly, this exposes the ultimate trap of credit card debt. Even if you manage to secure the absolute lowest, most competitive rate in the entire market, like that IDFC First Bank 2.50% we mentioned earlier, Doing the exact same math means it's still going to cost you between 30 and 36% a year, plus GST. So even the quote-unquote cheap option is incredibly expensive and just a massive drain on your wallet.
I want to leave you with this undeniable takeaway from all the data we've looked at today. There is absolutely no such thing as an affordable credit card revolving rate. There are only varying degrees of expensive. Whether you hold a super basic card or a heavy metal premium one, the math remains brutally consistent. The only true way to win this game is to avoid playing it entirely by paying your balance in full. So I'll leave you with this. Now that you know the true annualized cost, is whatever you are putting on that card today really worth paying a 51% premium on tomorrow?